Welcome back to the Deep Dive. It is Tuesday, February 24th, 2026. And today, we aren't just looking at a retail store.
No, definitely no.
We're really looking at this massive orange economic sensor network that basically covers the entire United States. We're unpacking the Home Depot's Q4 and fiscal 2025 earnings report, which just hit the wires this morning.
Yeah, and it really is the best way to think about Home Depot because, if you forget the aisles of lumber and power drills for just a second,
Right.
when you look at their data, you are getting a direct hardwired read on the American housing market. You get consumer confidence, and frankly, you're getting the pulse of the average homeowner's wallet.
You really are. And the mission for our deep dive today is to decode what, at first glance, looks like a massive mess of mixed signals.
Oh, it's a lot to sort through.
Right. Because we have these headline sales numbers that look negative on paper, but then Wall Street is cheering because they actually beat expectations. And we have a housing market that is technically frozen-like. Nobody is moving. Yet Home Depot is still churning out billions in profit.
Exactly.
Plus, there's this massive pivot happening in real time. They're moving away from the do-it-yourself weekend warrior, and they are going all in on the do-it-for-me professional.
And honestly, that pivot is the single most important thing in this entire report. I mean, it changes the entire investment thesis for the company. We've got the official transcript, the press release data, and the financial reporting on the market's reaction to get through today.
So there is a lot to unpack for you listening. Let's start with the numbers game, because if you just glanced at your news feed this morning, you probably did a double take.
I know I did.
Yeah. Home Depot reported adjusted earnings per share of $2.72.
Right.
Now, the consensus on the street was $2.52.
Right.
So they beat by 20 cents.
Which is huge.
Yeah, that is not a rounding error. That is a solid beat.
It is, especially in this kind of environment. And revenue came in at $38.2 billion for the quarter.
Which also topped projections.
It did, but, and they're always about with these earnings reports.
Always.
If you looked at the year-over-year sales growth, you saw a minus sign. Sales were technically down 3.8%.
Right, and this is where it gets so confusing. How do you beat expectations by a really wide margin while simultaneously shrinking by almost 4%? Is the bar just set that low right now?
Well, not exactly. This is where we have to talk about the calendar quirk.
The calendar quirk.
Yeah, it sounds boring, I know. But it is entirely critical to understanding the actual health of the business here. So fiscal 2024, the previous year, was a 53-week year.
Okay.
Fiscal 2025, which just ended, was a standard 52-week year.
Okay, so we are missing 1 week.
Right.
But does one single week really account for a 3.8% drop?
It accounts for a massive chunk of it. That extra week back in 2024 added about $2.5 billion to the top line.
Wow. $2.5 billion.
Yeah. So when you compare Q4 2025 to Q4 2024, you are essentially comparing a standard quarter to a supersized quarter. It's a math problem. It's not necessarily a business problem.
Okay, so if we strip that out, if we level the playing field for a second, what is the real story? Are they actually growing, or are they just treading water?
That is the key metric to look at, comparable sales, or comps. When you adjust for that extra week, comps were actually positive. Not huge, but positive, up 0.4% globally and up 0.3% in the U.S.
I mean, 0.3% is razor thin. It really feels like they're walking a tightrope right now.
They absolutely are. But you have to think about the broader context here. We have interest rates hovering just under 6%. Inflation is still incredibly sticky. The fact that the floor hasn't fallen out completely, that they're essentially flat to slightly up, it signifies immense stability.
Because in retail right now, flat really is the new up.
Exactly. And that stability is even more surprising when you look at the macro environment. The executives on the earnings call were pretty blunt about it. The housing market is frozen.
Yeah, frozen might even be putting it mildly.
It really might be. We are seeing this lock-in effect in full force. Home prices are up nearly 50% since 2019. Mortgage rates are basically double what they were just a few years ago.
So if I'm sitting on a 3% mortgage right now, I am not selling.
Exactly. You can't afford to trade up. You might not even be able to afford to trade sideways. And as a result, housing turnover, the actual number of people packing up and moving to a new house, is at 30 to 40-year lows.
Right. And usually Home Depot completely thrives on that turnover.
No, they rely on it.
Right. You buy a new house, you absolutely hate the kitchen, you gut it, you hate the ugly carpet, you rip it out. If nobody is moving, that whole new home spending impulse just evokes, well, nothing. It disappears.
It has disappeared. And that is exactly where the major consumer behavior shift comes in. The spending has moved from discretionary big-ticket items,
Like the vanity projects.
right, the full kitchen remodels, the I want this purchases, it's moved from that to necessary repair.
It's basically the difference between buying a fancy new suit because you want to look good at a wedding and sewing a button on your old suit because otherwise your pants are going to fall down.
That is a perfect analogy. It is strictly utilitarian right now, and the data completely backs this up. Transactions over $1,000 were actually up 1.3%.
Okay.
But when you dig into what those transactions actually were, it wasn't marble countertops, it wasn't high-end smart refrigerators.
Let me guess. Water heater?
Water heaters, pipes, electrical panels, and gypsum board. Just the completely unsexy necessities.
Gypsum board. The true MVP of Q4.
It's not glamorous, but it keeps the house standing. And this is crucial for you to understand if you're watching this market. People aren't renovating to increase the value of their home for a quick sale anymore.
Right.
They are renovating to maintain the asset because they know they are probably going to be living there for another 10 years.
Which brings us to the massive strategic pivot we mentioned. If the DIY homeowner isn't coming in on a Saturday to buy a new kitchen, Home Depot has to find growth somewhere else.
They do.
And they have essentially pushed all their chips into the pro side of the table.
This was undeniably the dominant theme of the earnings call. The pro customer, your contractors, your tradespeople, property managers, they outperformed the DIY customer significantly in Q4. Home Depot is clearly no longer just a store for dads on Saturday mornings. They are trying to become the back-end infrastructure for the entire construction industry. They call it the Complex Pro.
Complex Pro. I mean, that sounds a bit like a marketing term. What does it actually mean operationally? Because a contractor has always been able to just walk in and buy lumber at Home Depot. What is different now?
It's all about building an ecosystem. It's about removing friction for the professional. Take trade credit, for example. Home Depot has aggressively expanded its credit offerings for pros.
Is that just like a store credit card with better cash back rewards?
No, it's much deeper than that. It is fundamentally about working capital. Think about a mid-sized contractor for a second. They have to buy all their materials today, but they might not actually get paid by the homeowner for 60 or 90 days.
Oh, right.
That float can literally kill a small business. If Home Depot provides that float offering extended terms, much larger credit lines, they effectively become the contractor's bank.
Wow. That creates a serious moat. If I owe Home Depot $50,000 on 60-day terms, I am definitely not driving across town to Lowe's just to save 10 cents on a 2x4. I'm locked in.
Precisely. You are financially integrated with them. And then you add in the order management upgrades. They now have software systems where they can communicate with everyone on a job site, not just the business owner.
I saw that note in the transcript. It seems like a small detail, but if you have ever run a job site, communication is exactly where the money is lost.
Right. If the drywall delivery is delayed by 2 hours, the guy physically standing in the driveway needs to know that, not the accountant sitting back at the office. By solving that communication gap, Home Depot becomes an actual partner, not just a vendor.
Yeah.
But the biggest piece of this puzzle isn't the software. It's the hardware. The acquisitions of SRS and GMS.
Yes. This is the part I really wanted to dig into. So they bought SRS for roofing and GMS for wallboard and ceilings. These were massive, massive acquisitions.
Yeah.
And there was a fascinating detail in the report about the roofing market specifically.
The roofing anomaly. This, to me, proves their whole thesis. So here's the setup. In Q4, the roofing industry as a whole saw shipments drop by 28%.
Wait, 28%? That is not a dip. That's a crash.
It is a depression-level event for that specific sector, and the reason was actually simple. No storms.
Oh, weather.
Yeah, roofing is incredibly weather-dependent. You need hail, wind, hurricanes to drive major replacement cycles. And the back half of 2025 was just unusually calm, so the market bottomed out.
Okay, so the market is down nearly 30%. SRS must have taken an absolute beating then.
And that is the anomaly. Despite the entire market collapsing, SRS actually gained market share. They outperformed the industry significantly.
How is that even possible? If nobody is buying roofs, nobody is buying roofs.
It comes down to scale and availability. When the market tightens up like that, the smaller independent supply houses start to really struggle. They might cut their inventory, or they can't afford to get the delivery trucks out as fast.
Right.
SRS, because they are backed by Home Depot's massive supply chain, had the inventory and the logistics ready to go. They captured the few jobs that were actually happening because they were the most reliable option left standing.
So in a weird way, the crash actually helped them consolidate power.
Exactly. It completely validated the acquisition strategy. If SRS can grow their share when the market is down 28%, imagine what happens when the storms eventually come back. It's a coiled spring.
And now they are trying to tie SRS and GMS into the main Home Depot store operations with what they're calling the warm handoff.
Yes, this is the holy grail of cross-selling for them. Imagine a general contractor walks into a regular Home Depot store to buy lumber for a framing job. The pro associate at the desk looks at the order and says, "Hey, I see you're framing a 2,000 square foot addition. Do you have a roofer lined up yet? Do you have a drywall sub?"
And if they say no,
The associate doesn't just hand them a generic business card, they introduce them directly to an SRS or GMS sales rep. They are trying to capture the entire project lifecycle. They sell the frame, the roof, the walls, and the paint.
I mean, it makes perfect sense on paper. But historically, getting totally different divisions of a massive corporate entity to talk to each other smoothly is a nightmare.
It is notoriously difficult,
Yeah.
but management claims they are seeing early success. They are seeing that ecosystem effect really take hold. And to grease the wheels, they are deploying some pretty serious technology, which means we need to talk about the AI implementation.
Okay, I have to be honest here.
Yeah.
Every single time I hear AI in an earnings call lately, my eyes just glaze over a bit. It feels like total buzzword bingo. Is Home Depot actually using this, or is it just something to put in a press release for tech investors?
Look, I was skeptical too. Construction is a very old school industry. You do not usually see guys with tool belts geeking out over algorithms. But Home Depot's approach here is very pragmatic. They've rolled out a feature called Project Takeoffs.
Okay, walk me through what that actually looks like.
So a pro can upload a blueprint or even just type in a project scope into the app, say a 12 by 12 pressure-treated deck. The AI analyzes the request and instantly pre-populates the hundreds of individual items needed for that specific job.
Wow.
Not just wood. It calculates the specific metal brackets, the exact count of screws, the amount of stain you need based on the square footage.
Okay, that sounds really useful, but is it accurate? Because if the AI glitches and forgets the joist hangers, the deck falls down.
That is the obvious risk. The value proposition here is pure speed. A contractor might spend 4 hours at night sitting at his kitchen table working up a bid for a client. If this tool can do 90% of the heavy lifting in 10 seconds and he just has to review it and click buy, that saves him 4 hours.
Yeah, that's huge.
In this business, time is literally money. If he can bid on 3 jobs in the time it used to take to bid on 1, he wins way more work.
So it is a real productivity tool, not just a fancy shopping cart.
Right. And if that tool is exclusive to Home Depot's platform, why would you ever go bid anywhere else?
That makes total sense.
Yeah.
But, technology is really only as good as the physical delivery. You can order the lumber in 10 seconds on your phone, but if it shows up 3 days late, you're still screwed.
Which is exactly why their logistics upgrades are just as important as the AI. They are effectively Uberizing their delivery fleet.
Uberizing meaning tracking.
Real-time tracking for big and bulky deliveries. We're talking flatbed trucks carrying 2 tons of lumber. Historically, the delivery window for that was always, Tuesday, sometime between 8 a.m. and 5 p.m.
Which is an absolute nightmare if you have a crew of 4 guys waiting around, getting paid hourly to do nothing until the truck arrives.
Exactly. Now, the site manager can just track the truck on his phone. He knows it is exactly 10 minutes away, so he can tell his crew, all right, breaks over, get the forklift ready. It massively reduces the idle time on the job site.
And I read they have added specific drop-off instructions to this too, right?
Yes, the drivers have these new handheld devices that manage complex customer requests. Things like drop the drywall in the garage, not the driveway, or put the lumber around the back of the house.
It sounds so trivial to us, but moving a giant stack of drywall 20 feet by hand because the delivery driver was lazy, that is back-breaking work.
It creates immense loyalty. If Home Depot puts the materials exactly where I need them and the competitor just drops them on the curb, I am using Home Depot every single time. It's all about stickiness.
Okay, so they have the pro locked in with credit, they have the tech, and they have the acquisitions. Let's look forward a bit. What does the shape of 2026 actually look like, according to their forward guidance?
The guidance is cautiously optimistic, but the timing of it is a bit weird. They are forecasting total sales growth of 2.5 to 4.5% for the full year, comps flat to plus 2%, but the path to actually get there is shaped like a bathtub.
A bathtub, you mean it starts high, dips low, and then comes back up?
Actually, it starts low. They are predicting a very tough Q1. In fact, they expect negative earnings growth to start the year.
Wait, why? If the strategy is working so well, why the really slow start?
It's what they call front-loaded headwinds. A lot of this is just accounting. They are comparing Q1 2026 against a time last year before they had the full operational expenses of that GMS acquisition on the books.
Ah,
So expenses just look artificially high year over year in the first quarter. As the year progresses, those comparisons will normalize and the profit curve should swing back up.
so investors just need to be patient. Don't panic in April when the numbers drop.
Correct. The first quarter will look a little ugly on paper. It's part of the plan. But there are external factors too. Weather is always the wild card for them. During the earnings call, one of the analysts actually joked about looking out the window at 2 feet of snow.
I remember that exchange. The executives seem to have a real love-hate relationship with the snow.
Snow is tricky for retail. In the immediate term, it's great. You sell snow blowers, road salt, shovels. Those are high-margin, immediate need items.
Right.
But if that snow sticks around and spring comes late, it completely kills the garden season.
And the garden center is their highest margin area, isn't it?
It is massive. If people aren't planting flowers or putting down mulch in April because the ground is literally frozen, that revenue gets pushed to Q2 or worse, lost entirely. They're really praying for an early spring to get that bathtub curve moving upward.
There was one other major macro factor that everyone seemed worried about: tariffs. Given the political climate, import taxes are really the elephant in the room. Now, we're not taking any political sides here. We just want to look at the source material to see how the executives are managing this. So how exposed is Home Depot?
Surprisingly less exposed than you'd expect for a retailer of this size. Management dropped a very important stat on the call. Over 50% of their goods are actually sourced domestically.
Sourced in the U.S., that seems really high.
It is incredibly high compared to someone like, say, Best Buy or a fast fashion retailer. But you have to think about what they actually sell. Lumber, drywall, concrete, really heavy appliances.
Oh, right.
You do not ship concrete across the ocean from China. It is way too heavy. You source it locally.
So the sheer physical nature of their product acts as a shield.
It's a natural hedge. And for the stuff they do import, the power tools, the smaller hardware, they said most of the tariff-related pricing actions are already done.
Okay.
They have priced it in. They don't expect a major shock to the consumer in 2026 from trade policy volatility.
Okay, so pulling this all together for you listening. Home Depot beat expectations, not by hoping the housing market would magically thaw out, but by fully accepting the reality that it is frozen.
That is the perfect summary. They stopped waiting for the boom and they optimized for the freeze. They realized that even if people aren't moving, the existing housing stock in America is getting older every day. Things break, pipes burst, roofs leak. By positioning themselves as the ultimate repair hub and the best partner to the pro who fixes those things, they can win even without a housing turnover boom.
And the board of directors clearly believes in that strategy too, because they put their money where their mouth is.
The dividend raise, yeah, they bumped the quarterly dividend by 1.3% to $2.33 per share.
It's not a huge raise, but it's a definite signal.
It's a massive confidence signal. You do not hand out more cash to your shareholders if you think the core business model is broken. They are telling the market, we see the path forward clearly.
So here's where I want to leave it today. A final provocative thought on the bigger picture for you to chew on. Home Depot has proven they can survive and even make billions of dollars in a frozen market by serving the repair economy. They are winning. But what about everyone else?
What do you mean by everyone else?
I mean, Home Depot's fine because toilets still break whether you move or not. But think about the rest of the economy that totally relies on movement.
Oh.
The furniture stores. You don't buy a new sectional sofa if you don't buy a new living room. The moving companies. The real estate agents. The mortgage brokers.
That is a much darker thought. Home Depot might just be the exception here, not the rule.
Exactly. If housing turnover remains at 40-year lows for another year or two, Home Depot has this incredible lifeboat called the Pro. But does the rest of the housing economy have a lifeboat? Or are we looking at a bifurcated world where the repair business booms and everything else connected to housing just slowly withers on the vine? Is the repair economy the only game in town for the next decade?
It is a fascinating and honestly slightly worrying question. If the American dream of constantly trading up is on pause, Home Depot is essentially the doctor keeping the current house healthy. But I am not so sure about the rest of the ecosystem.
Something for you to think about the next time you're standing in the plumbing aisle looking for a 50-cent washer to fix that leaky faucet. That's it for this deep dive into Home Depot's 2025 earnings. Thanks for listening, and we will catch you on the next one.